Okay, welcome out to June 26, 2026 weekend review and playbook prep. This is where we're going to do some market analysis and show you how we prep partially for the week ahead. Let's go ahead and start out by looking at our market regime gauges. The market's a little shaky right now. I wouldn't really necessarily lean bearish or bullish at the moment. That's why we have the market condition at a very neutral, uncertain market. We had great run a couple months ago, but the last month has kind of been a little up and down. Our intermediate trend, however, is still bullish. Our short-term trend is bearish. You can see some of the history of the change here. We've been intermediate bullish for quite a while. So the market goes through its ebbs and its flows. Let's go ahead and start out by looking at the intermediate chart. Just do a little bit of looking at it. We go through a lot of situations where the intermediate trend will stay bullish and we'll have these sort of pullbacks. So you're looking at data right now from 2017 to 2026, and here's our most recent pullback. Our sort of philosophy or idea about a bullish intermediate trend is to mentally stay bullish even though the short term might be bearish, even though the headlines might be bearish. We don't want to really get duped into thinking too bearish when we have a trend such as what we're looking at now. So really what we're looking at is when the short term is pulling back like it is right now and we're intermediate trend bullish, we're looking for areas and spots that make sense for us to maybe buy the dip after strength. That's what we call it. We don't want to catch a falling knife. We want to buy things when they're going down, but we want to see if they can find some level of support, turn back up, and maybe on some strength, meaning higher volume, and get back into some names. So right now we are playing some defense, but really we're still positioned offensively. If we look at the short term, the idea here is that price right now just closed below the 50-day moving average. So our sort of first line of defense is the 20-day. So we usually start taking a little bit of defense at that point. If you're in one of the ultra aggressive or the aggressive or the moderate aggressive, we might be pulling back some of the maybe a leverage ETF that we have where we're trying to get a little bit more spice on the S&P 500. And then when we couple of the 50-day, we're usually shaving back some of the other positions or even starting to take on a little bit of a hedge using an inverse ETF. Right now, we've done both in our ultra aggressive, aggressive, and moderate aggressive portfolios. And our moderate and conservative, we usually wait till a little bit lower level to start really trying to play some defense there. Let's go ahead and look at what I'm calling the ERM summary. This is the exposure resistance model that we run in-house. But what it usually tells us is it gives us some stats on the trend, the breadth, what the sentiment is, and what the thrust is. Right now, looking at all of those combined, our overall score is -1. That's another sort of indicator to us that we need to not be aggressive in the market. We need to kind of be pulling back the reins. Having a little bit of cash is okay. Playing some defense is okay, especially when the trend score is kind of the weighted heavily on this exposure model. And, when the market's not in trend, it just doesn't make sense to have a whole lot in it. Breadth is the underlying, kind of like under the hood. So it's basically looking at advancing stocks versus declining stocks. Kind of amazing that we have a little bit of a, caution area on the S&P 500, but under the hood, most stocks are looking good, right? And so what this means is there's probably stronger stocks that are excluding the Magnificent Seven or excluding larger cap. We're probably seeing some bigger strength in small caps or mid caps, at least right now. It's tough to kind of swing the money back and forth between all those things always because sometimes the rotation doesn't last very long. So we really need to be kind of in a diligent, area, making sure that we're that we're not forcing the issue right now, and that we're just kind of being a little bit more patient before we get back offensively. So let's just kind of jump down. We're going to look at growth versus value really quick on this chart. This is basically a plot of the 4 different areas: mega cap, large cap, mid cap, small cap. And that's across the top. So that's this whole column is mega caps. And we're basically looking at the mega cap stocks, which I think in this ticker there's probably roughly 100 to 300. And we're looking at as comparison against mega cap value. And what that means is we're looking, is the market heavily invested in growth, or are they heavily invested in value? So usually money swings back and forth between those 2 areas. So it's growth divided by value. So when this line is sinking down, we basically have a situation where the denominator value is stronger than the numerator growth, right? So you can see right here that growth is losing to value right now. So when we do our deeper research, we're going to be looking at mega cap value stocks instead of mega cap growth stocks. And you can see right here on the chart. So this is mega cap growth. This is mega cap value. So you can see growth has been pulling back, but value sort of continues higher. Okay. So we look to kind of see which way is the money flowing inside the market. We do the same thing for large cap. And a quick scan right here will tell us that large cap is not as strong as mega cap, but growth is still value is still beating growth. And then we'll look at mid cap, and you can see right here that like growth is definitely, for a while now, has not really held up compared to value. And so we can see this sort of continued higher. And we're also looking at IWO versus IWN. And we can see right here that growth just barely went below value. So really the market's really value oriented right now. And so what ends up happening is, money gets shoveled into growth, and growth gets bigger and bigger and bigger and bigger. And then it gets to a point where investors are thinking it's gone too far. So they recycle some of that money into value, which is usually at a lower level. And it kind of goes back and forth between those 2 areas. So when we do our deeper research, we'll start looking at some value. And I think this has been the story now for a couple weeks. We've kind of noticed it's happening. Let's look at some RS ratios really quick. Another way that we look at the market is we divide it up into sectors. There's some traditional sectors. There's about 11 of them. And you would know them as tech, consumer discretionary, communication services, industrials, basic materials. There's about 11 of them. I add a couple more into there. I'm going to look at oil. We're going to look at bonds. We're also going to look at Bitcoin as a crypto proxy. We're also looking at the Magnificent Seven and the XMAG. The XMAG is an ETF that has the top 500 companies not top 500, but the S&P 500 constituents, and then taking out the Magnificent Seven. So it's kind of like looking at the big Magnificent Seven versus the XMAG. So for a long time, the Mag 7 might have been the only performers. And when we were looking before at that breadth, you could look at breadth and you could say, oh, breadth is deteriorating, but the market keeps going higher because the big Magnificent Seven companies, and we're talking about Microsoft, Meta, NVIDIA, companies like that were performing, the only ones that were performing, and they were performing so well that they were holding the indexes up while there was some under the hood deterioration. Now we're seeing kind of the opposite sort of happen right here, where we're seeing deterioration, but we're seeing, the other companies are really driving the market. And so it's kind of amazing. The S&P 500 has kind of been tailing down, but really it's because these companies have been tailing down, but these other companies have been doing great. So this is another way that we compare. And also looking at mid caps are doing well. Small caps are doing well compared to the S&P 100, the NASDAQ, and these others. Also, something else to notice on here is industrials. So we'll start looking at industrials, financials doing okay, healthcare. that's something that we're going to be looking at. In fact, one of our positions that we took inside of our ultra aggressive account was heavily influenced by this sort of uprun on healthcare. So that's kind of what we're looking there. Let's jump over to Market Lens. Let's first take a look at some of those Mag 7 names, the biggest names in the market. Microsoft, let's take a look at that. I mean, this is just something you just don't want to be in, right? I mean, this thing has gone from 540-ish now down to 360. It looks horrible. This is the area right here where it kind of comes down, bounces up, hits the 200-day moving average, and just sells off. Tries to do the same thing, and it's just sellers. So Microsoft not looking too good. So that's a bad mark against the Mag 7. Let's go ahead and look at Meta. I mean, it's horrible. What? Well, you want to just sit in this thing for years as it goes sideways and has extreme levels of volatility, going from $470 to $800. So doubling and then getting cut pretty much down. I don't know what this is. $815 down to $540. I mean, that's got to be like a 60. Let's see, 540 divided by 8. Yeah, 34% drawdown for Meta. We'll go ahead and look at NVIDIA. People are still talking about how great of a company to invest in NVIDIA. I mean, literally from the 31st of July to the 25th of June, it has basically gone nowhere. I mean, it's gone sideways, it's gone up, it's gone sideways, it's gone up, and now it's coming back down, right? So let's go ahead and look at Amazon. Again, doesn't look very promising, right? I mean, it's now, if you look at the highs of February of 2025 to where we are now, we're down, right? Let's look at Tesla. I mean, does that look very good to you? From December of 2024, it's down, right? Did it go down and then up and then down? And so not the best looking charts here. Now, here's one that looks great. Lilly, a position that we took in our ultra aggressive account. And do you see how going from left to right, it continues an uptrend, right? And we bought it yesterday. Today it's up 7%. And one of the reasons why we bought this was because of the strength in XLV that we looked at on the ratio chart. See if we can bring up XLV, and XLV basically kind of breaking out here, coming in with a lot of strength. And XLV has been kind of beat up for a long time, and maybe the market's ready to put the money in that spot, right? And so let's go ahead and look at SpaceX. First, let's look at Twilio. This is something that we tried to get into right here. We got a bulk of this up run. And then when it turned back over, we had to exit in the ultra aggressive. But now it's starting to look like it's found support at where it was low before. The two lows, this is support. The 50 days coming up. We'll see if this thing wants to turn back up and pop above the 20-day moving average. So that might be a consideration. And that's a lot of strength, going from $120 up to, 240-ish, a double. And now it's just having a natural pullback. So we'll see if that's time for that. Let's look at SpaceX, another big name. Had a nice run up for 3 days, 50% gain, but then just really, really sold off all the way back down to the price below the price that it opened at. And now just kind of going sideways. So this is a big name, by the way, also. So we'll look to see if this thing wants to turn back up. And if it does, it might be a spot to engage in. So kind of look at our summary for the week. We have our market gauge The conditions are neutral. The intermediate trend is bullish, and the short term is bearish. We're looking at growth versus value. Value is really leading, so that's an area that we have to be very concerned in. And if we look at the RS ratios, we can really tell that sort of the non-tech, the non-growth, the non-market drivers are leading the market right now. Looking at small caps, mid caps, stocks that aren't the Mag 7, right? We also have some healthcare, we have some financials, we have some of these others. And so this can swing back and forth, but right now this is where the money's at. And if we're looking at some key levels on the S&P 500, we are just below this orange line is the mark of the 50-day moving average. So we're just below that. We're looking at another key level just a little bit lower at 7335. Another key level below that is 7238. I wouldn't be, it wouldn't be crazy for this to kind of come down to that previous low if the market continues to stay weak. I would probably have some expectation to see some sort of support in this area, and then maybe try to make a move back up. And then the kind of game is going to have to be, can price get back over this area, back over the 50-day? Once price gets below the 50-day, unlike this area, a lot of times it comes up and it hits and it rejects, and that's going to be another indication that we're in a very bearishly sentiment type of market. But right now, we don't know. We're just kind of in between. If you can see from high to low right now, the ups and the downs are kind of contracting a little bit, and that's usually a good sign. So we'll see how things go. That's what I got for you this week. Take care. Have a wonderful weekend, and we'll be back at it on Monday.